Hi, everybody. Steve LaCrosse with the Lad Group. I've got Erin Martin on here as well. We're going to be getting this going here in just a few minutes. We're going to give everybody a couple of minutes to get logged in. So if you just sit tight with us, we will get this going very soon. We do have a couple QRs up on the screen. If you're watching this on your computer and have your phone handy, go ahead and you can scan those QRs and it'll take you to a page where you can find out what your home is worth. If you're a seller, if you scan the buying side, it'll take you to a page where you can explore what it means to be a buyer in today's market. So we'll be getting going here in just about a minute. All right, well, it is 4 o'clock. I know there are some people coming in. I can see the number is increasing. So we will get this going. I know everyone has full days and either that, whether it's in the office or getting ready for some adventure at night. So we'll try to keep this short. But again, I'm Steve LaCrosse. I'm here with Erin Martin. We've got our marketing director, Ronald, on. He's going to have his eye on the chat and any questions. So certainly feel free. Submit any questions that you've got. We did talk to a number of clients leading into this to get some ideas on what we should be talking about and what's most pressing to people. So we're going to be talking about what we're seeing nationally, what we're expecting to see throughout the year, obviously what we're seeing on a local level. And I would say probably the big one, I don't know if you'd agree with this, Erin, the big one seems to be the election and how that might play into the market the rest of this year.
Certainly comes up in a lot of conversations right now. And I think the big, for sellers, absolutely, kind of what should we expect for the listings that they have, live right now, the rest of the summer and into the fall. And then buyers often asks, kind of, should we be waiting? What's the right next step for us? And so I think it's important just to kind of get a data-driven perspective on this. So
absolutely. Ronald, actually, you have a poll. If we could get that going, we'll get a poll from everyone involved and get your take on this. What do you think the presidential election will do to the housing market in the fall, winter of this year? We'd love to see what you're thinking. Obviously, we do know what our clients have been telling us, but we'd love to see everybody on right now. Let us know what they think is going to happen. Give this a minute or so, and then we'll dive into the data. Seeing some responses come through. Right now, it looks mixed. When we do these in live situations, we have something called a Menti poll, and you can kind of see them as they come in and all the different responses, and it's a little more open-ended. And it really is amazing. No matter how big the room is, you get a pretty good idea that most people are on the same page with what they think is going to happen. All right, Ronald, can you share the results of that? Okay, so looks like 63% say that it's neutral and no effect. About quarter of you think that the sales and prices will go down, and a few of you think that prices will go up. So it is pretty mixed, but predominantly it sounds like it's a neutral effect. So if that's the case, why is there so much talk about the election and so much fretting about what might happen? And so let's dive into that. So Erin, I don't know if you want to take this one and get us going.
yeah, so this is the founder and CEO of Lexford Capital Management. And so he has really, kind of good perspective. His insight here is that presidential election years affect the national housing market and mortgage rates through three kind of interrelated channels. Really, it feels like it might be close to two because uncertainty and consumer confidence might be aligned here, but uncertainty, policy expectations, which are kind of an animal on their own, and what would result from the election, as it manifests later, and then consumer confidence. And then specifically, he's saying this is because consumers may choose to postpone major purchases or sales while they're kind of sussing things out and trying to get a good feel for the country's direction.
And I think that really does sum it up, and we'll point out that uncertainty is pretty common. We've taken a snapshot of the last 5 election cycles, but there really is always some amount of uncertainty, whether it's war, economic disruption, global pandemic. We've got some high inflation right now. There's always a certain amount of uncertainty that's out there in the market. And when you add this extra element of who's going to be running the country, it adds just that little bit extra amount of uncertainty that can affect, like you said, Erin, the consumer confidence and people's willingness to get out there and make a big purchase or make a big sale. But, really, when we look at it and we look at how does that uncertainty affect it, We've got this quote from Ali Wolf, chief economist, and she says, usually home sales are unchanged compared to a non-election year, with the exception being November. In an election year, November is slower than normal. So if you look at the whole scope of an election year, sales are relatively consistent throughout the year, with the exception of November tends to be a little bit more impacted than it does in, from non-election year to election year. And so this next chart shows us that typically we see, and we've talked about this in prior webinars, we talk about it in the state of the market, that there are cycles, and we typically see pending sales drop from, as we tick down. They usually peak out right around June or July, and then they tick down throughout the year. And normally there's about a 10% drop just in the month of November. But what we're seeing here is dating back to the early 60s. In the month of November, there's more like a 15% decline in the years that we have an election. So that tells us, I mean, that's a 50-year data set. So that's, okay, I can't do my math. That's a 60-year data set with a number of election cycles in there. And overall, it's 50% more move in the month of November than there is in a non-election year.
And I think it's important here, Steve, if you want to go back just one, to notate that this is actual home sales and volume. This is not necessarily prices. We've talked in the past about there being kind of a seasonality to prices and how those all matriculate in the end. And typically we see, Brian said it, before, that year over year, it's about an 8% dip, kind of in the off season, the trough season. But this is interesting to see that, in November compared to October, we see 10% fewer. And then, of course, a big pause in the November election year. And I would say that locally, this is what we've experienced as well. It's just kind of a wait and see. And certainly elections being so early in November, I can understand how with a 30-day cycle for escrows, that would really make sense that it would amortize that way.
Yeah. And so, we're seeing that we see an additional drop in November of an election year, but what happens after that? The big question is, obviously, this is the question on everyone's mind, is, well, what happens once the election's over? Do we see a continued drop in sales? Do we see a tick up in sales? And actually, it's pretty clear. 9 of the last 11 election cycles, the year after the election, sales ticked up. And again, like Erin said, this is the number of sales. These are national numbers, but the number of sales that take place in the year following the election has ticked up in 9 of the last 11 elections. And so, this tells us that it's not people getting out of the market. It's not people, again, Ali Wolf had this great quote: in December following an election and in the following year, the sales that are lost during November are recovered. It's not that consumers are saying, I'm nervous and I don't want to buy. They're saying, I'm nervous, let's just wait and see how things play out. And I think that's very, very true. And we've actually seen this play out with interest rates as well. Let's just see how this shakes out. And then once they see that either interest rates have come down or that they see that interest rates haven't moved, they go, okay, time to get on with our lives, time to, make that move. And so we're not actually losing those sales. It's just a gentle pause. One of the things that I wanted to point out here as well is, we'll talk about it in a little bit, about how the number of sales that we're seeing on a monthly basis is lower right now than it was in years past. And, one of the reasons for that is during the pandemic, that urged people to move quicker, to make a decision, to make a move. And so what it ended up doing was taking some of those people that were going to be buyers in 23 and 24, and they ended up being buyers in 20, 21, and 22. And so very similar to this, it's not a shakeup of how many people are actually doing it. It's just speeding up or slowing down when they're transacting. I don't know if hopefully that made sense.
Yeah, and I think that's a really important point, Steve, that, that was for a variety of reasons. Rates were certainly one of them, but also was kind of lifestyle and choices. It moved up, retirements, people were able to work remotely, that kind of thing. And so there was an expense of kind of that demand earlier than we expected. Probably rates really drove that. And then a quieting after that, as we would notice cyclically. And so I think this is just a natural kind of microcosm of it that we'll probably see in December. Weather definitely matters in Bend too. And so the seasonality of our market, our niche market, is definitely kind of also part of this. And so I think snow can really make a difference to how December performs. And I know that's only anecdotal, but I think it's interesting to note as well.
Yeah. So given all of this, given the cyclical nature, given what we see with, just patterns that we see with elections, we've seen that sales tick down in November. We've seen that they tick up the following year, but what does that mean for prices? So an election year doesn't alter the price trend that's already happening in the market. This is Ryan Lundquist, who's a residential appraiser and housing analyst. So it really, in terms of prices, there's a trend that's established. There's a trend that we're seeing, and kind of back to what we were saying with, it really doesn't even disrupt the number of people that are doing it. It just slows it down or puts a temporary pause on it. But what we don't generally see is a big course correction. And so Ronald, I don't know if you've got that second poll that we can pull up. Let's see what people are thinking in terms of prices. We've seen that a lot of people think it's going to be a net neutral impact with regard to the number of sales. But curious what people think will happen with prices over the course of the next year. And while people are answering that, I'll just scroll through and let you see what people are calling for this year, what the experts are calling. There's 7 different experts on this list, and you can see there's a range for the year, just this year, from 0.5% to almost 5%, with the average being about 2.8% growth. This is nationally. And we'll point that out a couple of times. Obviously, like Erin said, there's some very specific stuff that happens in Bend that might be different than this, but it looks like we've got a pretty good consensus that 70% of the people think that it will go up slightly, and then pretty mixed across the board for the rest of them. So let's dive in. Let's see what happens nationally in the years after an election. Erin, you want to take this one?
Absolutely. I mean, what we're seeing is that 7 of the last 8, only 1 went down, and that was one that was a unique scenario, I guess we can say. And I think it's just really interesting to note, because I do think there's a lot of fear mongering that can happen around this. And so if we see that actually prices go up, I think it's very helpful contextually.
Yeah, absolutely. And so why is this? Why is it that we just keep seeing prices remain firm? We definitely have seen a major slowing over what the appreciation looked like throughout the pandemic, of course. But if we look at this and we take this quote from Lawrence Young, he's a chief economist with the National Association of Realtors. We've quoted him before. He really does provide some great insights. And he said, home sales have lingered at 30-year lows. And since 70 million more Americans live in the country now compared to 3 decades ago, it's inevitable that sales will rise in the coming years, and inventory will grow steadily for more home construction and various life-changing events, which require people to trade up, trade down, or move to another location. And the reason we bring this up is we've talked about this, like I said, in the state of the market. Ronald, I actually think if you can share the link to our most recent state of the market, you can also get registered if you're not already on our list. We're preparing for the next State of the Market edition, which will come out at the end of August. But we've talked about this. There are tens of millions of Americans in that millennial generation that are reaching peak home buying age. And so with that added pressure, that added demand of people stepping into the market, it has had this buoy effect on prices. And so if we,
I think it's important to say, Steve, that, we've talked about this a lot before, so not to be redundant, but while all of kind of the millennials are coming of age into kind of home buying era of their lives, if you will, the boomers, kind of generation is not necessarily trailing out quite like we thought. And so it's not as much of a ebb and flow as we expected, but mostly just a lot of ebb. and it's kind of helping to keep prices up and keep driving demand. A lot of boomers are aging in place and kind of, doing multi-generational housing. And so we're not necessarily having people leave the market quite at the same rate. And so that's an important factor to what you're about to say, I'm sure.
Yeah, well, that's exactly right. I mean, we're seeing, if you watch the headlines, you're seeing sales are down, pending sales are down, inventory is growing. Yet year over year, the average price in Bend is up 5%. And like Erin said, you can see from this chart, if we actually had zoomed out a little further, you could see the pattern, the cyclical pattern. There usually is a peak to trough cycle that we see, where we usually peak out in terms of median price this time of year. And so we do try to compare it to a year ago at the same time. But we've remained strong despite interest rates still hovering around 7%. There's enough demand and there's enough interest that it has just kept prices up locally, in particular, up about 5%. You saw that the prediction for this year is 2.5% locally or nationally, and we're sitting at a 5% gain right now. Erin, it looked like maybe.
Well, I just thought, do you want to speak a little bit to how kind of our luxury demographic kind of,
Sure.
this? Because I do think it matters.
Yeah, so that's a good point. And we try to point out we do a monthly market stats and data update. So on a monthly basis, we're putting something out, and Ronald can share that in the chat as well. And we talk about this. That median price will fluctuate. And part of why it fluctuates, it's a few different reasons. One of which, normally we see the highest median price this time of year. This is normally the time of year where we have the most amount of luxury listings on the market. And generally, those are sellers that can wait for the perfect time to sell their home and not sell it in an off season, and sell it when there are more people here and more people visiting, and it will get more exposure. And so we often see luxury listings come on and sell this time of year, which, when you're looking at the data and the smaller data set of homes that are actually selling every month, that has the tendency to affect those numbers. Median and the average price can swing from month to month. Sometimes it can be a 5 or 10% swing on just any given month, because the data set's small. And when you have a number at either extreme of that data set, it can sway the numbers a little bit more. So we do caution people to, not only take it with a grain of salt, but then also look into, well, what does my price point specifically look like? What does the sub median price look like? What does the 2 times median price look like? And if we did that, we'd see very different numbers in terms of average prices, average days on market, number of listings, amount of inventory. And so again, I'm glad you brought this up, Erin, because this is what we always tell our clients is, let's talk about the specifics. This is broad. Yes, we're diving into Ben's numbers, but that's still very broad, and it doesn't speak to your neighborhood, your area, your quadrant, your price point. And so we love to get on a call. We'd love to talk through all of these details so that we can really get into the specifics on how it affects specifically what you have or what you're looking for. So let's talk pending sales. So again, similar to price, this is also very, very cyclical. And what we see is pending sales are down about 4.5% year over year. This chart is showing us pending sales in Bend. Again, if we zoom out a little bit further, you can see that, even just going back to 2019, that year we peaked at about 1,200 pending sales for, I believe this is a rolling average. And so although we're up slightly year over year now, we're actually still down pretty significantly from what we had grown accustomed to back when we thought we were in a very busy market and things were strong and steady. We've actually seen a sizable decline in terms of the number of pending sales from pre-pandemic to now, but a slight decline just over the last 12 months. And so what does that do to inventory? There's fewer homes going pending, so it's not surprising that that inventory is starting to grow. And so year over year, we're actually up about 33% in terms of the inventory that we have. We're at about 4.8 months of supply. We've talked about this before. Just if there were no new homes to come on the market, based on the pace at which homes sell, how long would it take to work through our existing inventory? And that will give you the number of months of supply. And so we're at about 4.8 months. And I think we do have a slide shortly just showing, well, how does that relate? What's a standard normal market, a balanced market look like? And we'll get to that in just one second. What I wanted to share now was kind of give you a broader perspective. This gives us a 5-year snapshot of pending sales. Of inventory, of the number of homes that are actually for sale. And so we zoomed out a little bit and took it back to the early 2000s. And this gives you a much better perspective and kind of goes back to what we were saying about how cyclical this market is. But historically, there aren't many Julys where we've had less homes for sale than we do now. Most of the Julys dating back to the early 2000s, we've had more homes for sale. And again, today's not the day to go into all of the reasons why that might be, but Erin touched on a few of them. People are staying longer. They're locked into their interest rates. They don't want to get rid of it. And so Erin, you want to touch on months of inventory and what we see?
Yeah, I mean, I think this is a really useful one because it really shows that 6 months of inventory is a neutral market. And so, if no one else comes on the market in 6 months, they'd all be gone. That's nice and fair. It means buyers can have inspections. It means that, you're allowed to bring a contingency to the table these days and that kind of thing. A seller's market would be anything less than 6 months. And so I think we're still in a seller's market. You can see here being in kind of the high 4s. We're definitely in a seller's market still. You're still in a really good position. The worst, actually, that this is national news or data, but specifically when we look at kind of from a local perspective, our highest was 23 months worth of inventory when we looked at Bend, and that I think was in like early 2010, which was the lowest of the low here, which is very interesting. So it has been as high as 23 months, and we're at 4. So certainly no need to panic in any way, shape, or form. And the subtle increase, oftentimes you'll see headlines that will say they've doubled, the months of inventory have doubled. And it's like, yeah, well, they went from 2 to 4 in the last year. So I think that's good context for sure.
Yeah.
We see in 2020, we were less than a month. We were 0.9 months worth of inventory, depending on how you slice and dice the data. And now we're at 4, but we're still not even, up to kind of where the neutrality, or we're getting closer to the neutrality. And so I think this is a good one. I really like the one.
And it's the reason we often refer to it as a return to normal, a normalizing of a market, a stabilizing of a market. Less than a month's worth of inventory is not healthy. That's just not healthy. It's not sustainable. It's not good for buyers. Sellers, were benefiting from that for a little while, but then those sellers were buyers somewhere else. So they weren't getting off without having the impact of that as well. And so this return to normalcy, it allows, like Erin said, it allows a little bit more of a review process, a little bit more of an investigation, weighing all the numbers. How does this affect my payment? Which brings us to something that we haven't talked about yet, which is really one of the biggest things that affects all of this, are the mortgage rate projections for the next year. And so I'm sure, if you've been watching the news, there's been lots of calls for interest rates to fall over the course of the next year and the coming years. But, really, when you look through the projections for the next 12 months, they're not huge. It's not like these are expected to drop off a cliff. The Fed, they manage lending rates between banks. It's different than this. So when you hear rate cuts from the Fed, that's slightly different than this. They do correlate. But, the reality is everyone is being very cautious, very steady in their approach to how we deal with inflation, which then has the impacts on how much things cost, how much liquidity people have to spend. And so again, if you're waiting for mortgage rates to come down, there is some expected relief. We have seen, what we should have put up is the expert predictions over the course of the last 6 months or the last 12 months, because those have shifted dramatically as well. But we just point this out, that this does affect both buyers and sellers. And as we see interest rates come down, we will see buyers step in. We will also see sellers step in, because those sellers now are free to buy something at a slightly lower interest rate. And so it's really, where does that supply and demand balance even out? And so, if we're looking at the forecast for the next 5 years, as a professor of economics at the City University of New York, it says, when it comes to the real estate forecast for the next 5 years, I'm cautiously optimistic. I believe we're going to see a lot of ebb and flow over the next 5 years, some highs, some lows, but overall a very healthy market. Prices should continue to rise, though more slowly, and buyers might enjoy more options as inventory expands. But remember, as Erin and I have been saying, real estate is profoundly local. What happens on a national scale can manifest differently in our backyard. And so we do think it's important to watch the headlines. We do think it's important to be aware of what's happening throughout the country. We do have a lot of people inward migrating, so migrating from other areas. And so what's happening in their hometowns affects what we see here. But overall, we're seeing a return to normalcy. We're cautiously optimistic in terms of how many homes there are for sale. Some of the things that we've pointed out in our monthly stats and data page is the number of new builds that we're seeing. Builders are pulling permits at levels that we haven't seen for a few years. That shows strong confidence from the builder community. We're seeing about 30% of the homes that are coming on the market selling quickly, selling within a week. So if they're priced well and marketed well, they're selling fast. And then we're also seeing the days on market tick up. So the homes that aren't are sitting a little bit longer, and buyers have options. So anyway, we could turn this webinar into an hour's worth of data. So I need to stop myself. Erin, were you going to say something?
Well, and not to put you on the spot, but I was curious if you checked the numbers lately. I haven't seen them lately, of the balance between cash versus, kind of loans that we're seeing. And specifically, as we anticipate rate drops, I wondered if you'd seen the latest on that.
Yeah, so I believe this last month we were right where we normally are, which is about 75-25. It actually might have been a little bit closer to 65-35, but somewhere in there, it's usually about that 3-to-1 in terms of number of loans. And that has been the case even when rates had shot up tremendously. We did see some more cash buyers step in and be a little bit more opportunistic in that sense. But overall, that balance is still there. It's usually somewhere in that 75-25 range, 70-30 range. And I haven't seen a lot of fluctuation with that.
And there's not great data to show kind of contingencies. I just only bring this up because it's relevant in terms of talking about who's in migrating and people who are coming in from other areas. But we are starting to notice a fair bit of that happening. And I would say in terms of our listings, we're seeing a lot of contingent offers these days. And so I think it's really interesting to kind of watch and monitor how that kind of unfolds.
Yeah, I mean, that in talking with our lenders, there's lots of discussions about how do we structure this so that we don't have to make it contingent. Perhaps it's a home equity line, perhaps it's some type of bridge financing. The people are really trying to get creative because there's a lot of pieces that need to fall into place. And so, yeah, absolutely. There's lots to discuss. I mean, really, this brings us back to kind of where we started. We would love to schedule a session to sit down, talk through what your needs are, how the individual dynamics of your price point, your location can affect your search, whether it's, this year, next year, in 2 or 3 years. We really do love the idea of being an advisor and working through the process with you. So feel free, go ahead and scan those, or you can certainly reach out to us. We're at benpropertysource.com. You can email info@benpropertysource. We'd love to continue this conversation and dive into the details a little bit more. Erin, we are at 26 minutes, pretty decent.
Yeah. Do you want to take 4 minutes to answer a question that Scott Graverson brought up?
Okay,
It,
I can see it.
you'll have, unique insight just kind of with your Tethero background, but regarding weather fluctuations on sales, is there data to support purchasing land is advantageous for buyers during a time with snow on the ground? And I think anecdotally, we can absolutely speak to that, and then we can supplement with the data privately to you, Scott, over an email if you'd like.
Yeah, so specifically for land, you're asking? Is that right? I don't have the question in front of
It
me.
was specifically for lots, yeah.
Yeah. Yeah, so I'll pull up the details and get the individual data for it. I don't know that I've got at the tip of my tongue what that might affect, but or how much effect that might have. But just generally, both land and homes, there are sellers generally who are selling their homes while there's a lot of snow on the ground and in the off season are generally motivated to sell, right? It's unfortunately it's not the best time that a home doesn't show its best when it's snowy and slushy and muddy and gray. And so there are definitely opportunities for buyers in that off season to find a more motivated seller, whether it is for a house or for a lot. With land, some of the things to think about with land, and if you were to buy it in the off season, generally speaking, it's going to take a number of months to get your planning and your permits together. And so depending on what your plan is for getting going, we do see people trying to time their land purchases so that they can either break ground prior to the freeze taking place or once it starts to thaw in the spring. But yeah, I believe there probably would be some data that would support that land sales and certainly home sales, there are opportunities to be had in the off season. Not
There's some,
every seller is, but
yeah, I was gonna just add to that there are some, areas that maybe wouldn't be as advantageous, and just because at times there's a blanket of snow, and so you can't, fully do as much due diligence on the lot itself. But other than that, I think I'm with you, Steve, that would
yeah.
make
Well, we appreciate the question, Scott. Anyone else, please send us your questions. Please reach out. We would love to dive a little bit more into all the details. We thank you so much for taking a few minutes out of your day today to join us, and we're here for you. Thanks so much. Take care.